When we talk about loans, we think about buy now, pay later, or we think about travel loans or taking loans to enjoy or buy or shop. But actually, does it make sense to take loans for these things? Maybe no. But there are various ways in which you can take loans to make more money, to make better returns out of investment. That's called leverage. And all HNIs do it. A lot of HNIs do it. High net worth people thrive on taking loans to make more money, and this is a secret which a lot of individual investors do not do because they have a mindset that loans are generally bad, which might not be actually true. So in this video I'll try to explain how some people use leverage to enhance their returns, but you should remember that it's not that straightforward. I mean, you need to understand the product, you need to understand why you're doing certain things. Just because someone else is doing it, someone else is making money out of it, does not mean that is the right thing for you to do.
What is Volt? Volt is a platform that enables retail customers to get instant and low-cost credit by pledging their MFs in stocks. This facility was earlier available only to HNIs. However, this feature is now being brought to common retail investors like us by platforms like Volt. This process is 100% digital and you can get funds against your holdings in around 5 minutes. Why borrow against your mutual fund holdings? Tide over any emergency situations requiring urgent funds, any health emergency? Salary delayed? Income from business not up to the mark in a particular month? Your mutual fund holdings can come to your rescue and help you borrow money against it to tide over emergencies. Stay invested and increase potential returns. The longer you stay invested, the power of compounding does its wonders. Redeeming your holdings instead of staying invested might make you lose on the benefits of compounding. Instead, borrow against your holdings when needed using platforms like Volt. Defer taxes. All of us know about the taxation on equity and debt schemes. For starters, equity mutual funds sold before 1 year and debt funds sold before 3 years attract short-term capital gains. Redeeming your funds might increase your tax liability. Borrowing when you need money against your funds might be a smarter choice. Opportunity to leverage. If there are some good high-yield opportunities or equity opportunities, you can borrow at a low rate using Volt and lend at a higher rate and make money. This is one of the ways how NBFC and HNI make money. How does it work? Accessing credit lines against MF and stock holdings is a very simple process with Volt. Following are the steps involved. Number 1. Check credit limit. Sign up and share details like PN, no, mobile, and email ID. Your holdings are evaluated and your credit limit is shared. Number 2. Pledge your assets. Accept the offer and borrow money against your holdings as security from Volt's trusted NBFC partner. Number 3. Instant KYC. Complete the KYC process, which is again fully digital. Number 4. Withdraw money. Withdraw money to your desired account. Repay as per the desired schedule. Your interest is calculated on a daily basis, which means you can return the money whenever you want and there are no prepayment penalty charges. Features of Volt platform. Fully digital, 100% end-to-end digital process. Very low interest rates starting from 9% PA. Avail limit from as low as 25k to 1 CR in 5 minutes. Loans provided by trusted NBFC partners Bajaj Finance, Myri, etc. 100% eligibility. No minimum restriction on CIBIL score, income, profession, or employment status.
Hello everyone, welcome to my channel. And this video I'll talk about a platform which offers you personal loan at a very low interest rate called Volt Money. They offer you loan against your stocks and mutual fund at a rate which is much lower than 10%. So first of all, does it even make sense for people to take loan, or are there any scenarios where taking loan makes some sense? So I'm one of those people who generally avoid taking loans for personal reasons. I hardly use credit cards. I know there are some benefits for using credit cards, you can avail points, but I generally do not like the idea of taking loan, using credit card as a form of taking loan, because it puts you into a vicious circle where you end up buying things which you don't need. But taking loan might not necessarily be bad. There are situations when you can actually use loan as a tool to enhance your returns or reduce your overall outgo. So in fact, if a lot of people might not know that Warren Buffett, he used leverage in some form to enhance his return. So basically his company Berkshire Hathaway, originally an insurance company. So what does an insurance company do? Sell insurance premium, which means they get some premium in the balance sheet against those unclaimed payouts. And now what happens is this money is in the balance sheet, which can be deployed into various assets. This is what he did. He invested in good companies, invested in shares, and made a lot of money in those investments. And eventually, when he had to pay out those claims in the form of people, when people died, some people died, and they had to, Kins had to take the claims. The amount which he had to pay was much lesser than the returns on his investments, and thus, using leverage, he was to generate crazy returns. In fact, there are studies which shows that you can replicate a private equity portfolio by taking leverage on a small cap listed portfolio. So all of these things make sense if you are a very astute investors who know when to take leverage. For instance, when the market crash and there's a good opportunity, people can use those stocks to enhance their returns. Maybe they can take 20%, 25% of those stocks, collateral value as loan, and further buy more index, and this enhance the returns when the market goes up. Similarly, a lot of people, what can they do is, if they have a lot of outstanding loans which are at a higher cost, they can consolidate those loans using a low cost loan against their mutual funds. Thirdly, if you want to make some purchases in an asset which can appreciate a lot over time, for instance land, a lot of NBFCs and banks do not offer an attractive interest rate for land. There you can pledge your stock mutual fund to invest in those assets. But one thing is very critical: you need to understand that leverage is a two-way sword, because when it's going in the correct direction, you're making money in the your underlying asset, everything getting enhanced. But if things going wrong, you have to pay an interest apart from the losses in your assets, underlying assets. So you have to use leverage in a way where you can take control of your investment, rather than it making you very nervous. So that is critical. The good thing I like about Volt is the process is pretty straightforward. You just have to register, you just put in your PAN details, and you can instantly the amount of money you can borrow against your facility, and they disperse within the same day, within half an hour to 1 hour, which is excellent. And I think this is a tool which you should have, even if you don't want to use it. Rather than dipping into a high cost personal loan, you should have this kind of line where you can take it whenever you want. So yeah, this is definitely a product you can explore.